Hello, everyone, and welcome to the Weekly Watch. I'm John Briggs. Market gyrations continue. On the rate side, we've seen yields decline lately, especially in the UK, where inflation came out a bit softer than expected and showed broad signs of stabilization. We don't see the peak in inflation in the UK for the next several months, but even this small miss had UK yields falling considerably, dragging other global yields with it. This was accentuated later in the week when we saw some weak PMI numbers across various geographies with recession signs, or recession fears, I should say, rising. We certainly agree that yields got a little bit stretched there a week or two ago with aggressive pricing built into rate markets when it comes to central banks, not just in the UK, but perhaps also in the US as recession talk builds. And listeners know we've been on this recession theme for some time, a couple months now, really, but recognize that we were going to be early on it. But it is clear this week that worries about growth continue to rise. We've seen this impact in a variety of ways. It aided the aforementioned move lower in yields, move lower in commodity prices, but it's not really helping risk assets such as stocks because they're caught between the slower growth expectations offsetting potentially less hikes from central banks. I personally remain cautious on risk heading into the fall. We've got some earnings seasons coming up, and the autumn is typically a volatile time, along with quantitative tightening from various central banks being started or in full steam by then. So we'll see what happens there. But what does this mean for the FX side of things? For that, I have the co-head of G10 FX strategy with me, Brian Daingerfield. Brian, thank you for joining. Brian, I'm going to be blunt. Has the dollar peaked?
So first of all, thank you, John, very much for having me. When you think about if the dollar has peaked, it sort of implies that when you hit a peak that you're going to see a pretty quick, move over to the other side and lower. And I think instead the outlook is probably balanced for the dollar. There's a couple of big pillars of support for the dollar that we have been watching. The first one is relative monetary policy, and the second one is relative growth. On the relative monetary policy side, I think you're right, John, that the positives coming to the dollar from relative monetary policy are waning now. Certainly what the Fed did in mid-June sort of pushed back against this idea that the Fed was at peak hawkishness. But as the market starts to become more concerned about global growth, the Fed having delivered a significant amount of tightening relative to its other peers, we talk a lot about the Fed being behind the curve, but they're really ahead of a lot of other central banks. And so they may have more flexibility to slow or pause if needed. And so the support coming from the monetary policy side for the dollar is probably going to be less. And I think we've seen that play out in the last couple of weeks as Eurodollar, for example, has been relatively stable, albeit at its lows. But there's another side of the coin, which is still important and a potential support for the dollar, which is relative growth. As we think about the growth dynamic over the next 6 to 12 months, if the US is moderating, what's happening to the rest of the world? The US is a global consumer, world's strongest economy. As growth slows in the US, that has important negative implications for other economies as well. And the US economy is probably better positioned than most to weather a potential storm, whether that's coming from high inflation or from geopolitical factors. We know the US is an internally driven economy. It's less exposed, for example, to the Ukraine crisis, to higher energy prices, even though we're all certainly feeling that. It's lower exposed than most other economies. And so the dollar also happens to be the global reserve currency and the world's highest yielding safe haven by a good ways, much higher yields in the US than in Japan and Switzerland, for example. So that's a potent combination for the dollar, that if the world's economies are seen as slowing, if it's slowing in sort of a moderated way that the Fed can slow down tightening, but we're not heading towards a recession, that's something that maybe could unlock some dollar weakness. But we know the economy tends to work in boom and bust cycles. And so if the economy does continue to slow or show signs of slowing, that could actually support the dollar because of its safe haven status. So the way we're thinking about the dollar is that the risks are more balanced here, that the kind of Fed hawkishness fueled acceleration in the dollar we saw earlier in the year, that period is probably past, but the conditions for dollar weakness are not bulletproof either. And so we see a more balanced outlook for the dollar from here.
All right. So you've mentioned kind of this growth differential impact and rate differential impact and potentially, monetary policy differential impact. What are some of the other themes you're looking at more broadly, kind of just for the second half of the year as we head into that?
Well, I think the big question in the market will be the hard landing versus soft landing debate, not just in the US, but globally. How are central banks going to be able to navigate this period where they need to fight against the devil they know, which is inflation, while they also have to be mindful of the signs that the consumer may be slowing down, consumer confidence has fallen in most places, and higher prices are potentially sapping or shifting consumer demand. So as we think about what are the factors that could contribute to a hard landing or a soft landing, one of the things we should be thinking about is, are there conditions under which central banks can slow down their tightening cycles, regain some flexibility without necessarily pushing consumer spending over the edge? And probably the biggest specific thing we could look at is commodity prices, maybe energy and food prices, most importantly. So you could imagine a scenario where if oil prices and food prices were to start coming down, but demand did not, come down significantly with it, then the pressure on central banks from headline inflation may moderate. And conversely, consumer confidence might actually rise if fuel prices, for example, were to start coming down. So oil and energy prices in particular are something we're going to be very focused on in the latter half of the year. And there, I think the story is very similar to what we've been talking about, which is the near-term picture is still, I think, very positive. Demand for fuel, gasoline, and the summer driving season is extremely strong. Inventories of both crude oil and finished product, like gasoline, for example, are still very low compared to, not only compared to recent pre-pandemic norms, but also relative to the amount of demand we have. And at the same time, we have an environment where economies are looking for alternative sources of energy as we sort of phase Russia out, given sanctions. And so there's more demand, higher demand than pre-pandemic, and there's fewer sources of energy as Western economies are looking for alternative sources. And so the demand supply imbalance is likely to remain in place. So what we would likely need to see is some give from the demand side. It's a question of how much central bank tightening is impacting that. Higher prices alone could be something that's changing consumer behaviors, and that's something that's certainly a risk, and the market is certainly keen on that as a potential risk to the outlook. From the supply side, as I mentioned, Russia is being essentially phased out of Western economies. Certainly, it seems like there's still demand from China and India, among others, for Russian oil. That's certainly a geopolitical issue to keep an eye on over the second half of the year. But there's also the relationship between the U.S. and Saudi Arabia. President Biden is set to visit Saudi Arabia sometime in mid-July. And that could be a moment where maybe a mending of relations between these two nations could lead the Saudis to potentially increase their speed of production quota increases. And so the energy side of the coin is going to be very important. We know that inflation is very key to what the Fed is doing, what global central banks are doing. Headline inflation being very high is limiting central banks' ability to pivot in case growth does slow down, as the market feared that it will. And oil prices have very clear implications for consumer confidence and consumer demand. A fall in energy and food prices would lead to, by itself, an increase in discretionary spending power because you're spending less on these necessities. So oil prices and energy is going to be a big focus in the second half of the year, and it has so many implications across all the macro factors that we watch.
Yeah, and in addition to what you said, like if you get falling oil prices and that takes a little pressure off central banks that are driven or targeting headline inflation like the UK or Europe. And it certainly seems like, though, that some of the things you've talked about in the past have been that the Saudis, for example, or OPEC can increase their production quotas, but that doesn't necessarily mean they have the capacity in order to do it, or there's capacity issues in the U.S. when it comes to refining and refining products. So how do you get to lower oil prices? It feels like that would be the easiest way, as you said, to go to a soft landing. But what's the path to get to lower oil prices? Because if you destroy demand too much, that's not a soft landing. So how do you see that potentially evolving?
It really feels like at this point, it probably has to come from the demand side. So you do need to see some slowing in demand. And certainly for finished products like gasoline, we are in a period of very high seasonal demand, at least here in the US. So you could see implied demand come down, though that's something that's already factored in because that's a seasonal trend that's pretty well established. But on the demand side, there is simply a lot of demand right now is very, very strong. The problem is that investment decisions from the production side are made today with future demand in mind. So, if you start producing, if you make a commitment to a capital expenditure today, if you're an oil extractor, then you're committing to future demand, not today's demand. And so as companies become concerned about future demand, that's something that could lead to lower production and lower CapEx now. And I think we've seen that as well. On the supply side, you also mentioned supply shortages and labor shortages, which is an important part of this story as well. Oil is not immune to the supply chain disruptions that oil prices themselves are helping to cause, right? Labor shortages, part shortages, and the like. You also mentioned Saudi Arabia and OPEC's ability to actually produce up to quotas. That has been a theme as well, that most countries have been really unable to capture the increases in quotas. So OPEC's been increasing their monthly oil production quotas pretty much every month. They actually increased the speed of quota increases at their last meeting earlier this month. But they haven't really been able to, that just increases the total amount they're able to produce under their agreement. It doesn't actually lead to new barrels on the market on a one-to-one perspective. And so Saudi Arabia has the most spare capacity, at least estimated to have the most spare capacity in OPEC, along with the UAE. Iran is also in that conversation, though bringing Iran back to the table obviously involves an Iran deal, sort of rejoining the JCPOA, which has its own complications as well. So the supply side feels like it's going to be tougher for that to come online in a very significant way. You've seen President Biden is really throwing everything he can at this problem, things like gas tax holiday, releases from the SPR, all of those, as we have seen, are only modest impacts. The supply side feels like it's going to be in for a challenging time. So it feels like you probably do need some demand slowdown, or maybe just fears of a demand slowdown to bring the market back into balance.
Yeah, hopefully hopefully you get the fears playing out, because that doesn't mean the actual demand destruction, but kind of feels like a fine, eye of the needle. You're trying to get there where you reduce demand, but not enough to make it a hard landing. So, all right, well, thanks, Brian. I think that you're right. The energy side of things obviously drove so much of the behind the curve type nature of arguments for central banks, which impacted policy and assets so to such a great degree in the first half. So the future of energy prices in the second half is going to be key. Thanks for all that. I really appreciate it. And next week, it is relatively light. We got some inflation data out of the US and UK, some US and Europe. UK has GDP data, and a short week in the US is following that. We get the employment data the next week after that. So keeping an eye on that. Thank you for joining us for this episode of the Weekly Watch. As always, please remember to hit subscribe so you can watch our latest episodes as soon as they're available, and hit the like button so it's easier for others to find it. Thank you, and we'll talk to you next week.